Hey gang, welcome to another episode of Beat the Bogey. I'm here in the Macomb Theater with my senior analyst Kyle Aaron, and we're here to talk about news flow that we've had out over the last few weeks on the state of our economy here in America. Is there a recession on the horizon, or is it just a mirage? We're going to get at this seriously, so stay with us. We'll be right back. Okay, gang, we're back. We're here for another exciting episode of Beat the Bogey. We're here in the Macomb Theater. This is our stage for showcasing how we use our investment process here at Mitchell Anthony Capital Management to turn news flow into buy-sell decisions for investment assets. Kyle Aaron is my senior analyst, and we're going to spend some time today, and we're going to dig into what's going on with this recession talk. And is it real? Is this the time to kind of turn your portfolios into gold and treasuries, or is this a time to kind of stay fully invested because there's really no storm on the horizon and to keep the sails of the sailboat up? So with that, Kyle, let's get into this talk here.
Let's get into it.
We've had a lot of news flow over the last few weeks, and it's been about recession. I mean, you Google, news on the economy, and whether it's the Wall Street Journal, whether it's U.S. News, whoever, they're talking recession. Is it on the horizon? What's out there? This concern about recession, I've never seen it so high, hardly ever before in history, at least from what the media is talking about.
Yeah, I think that's fair. If you Google recession, you'll get a story from virtually every major news outlet saying, recession on the horizon, or is the recession coming? In part fueled a lot by kind of speculation that the trade war is going to send us spiraling into a recession.
Yeah, I think this is where we have to certainly raise our eyebrow and get a little bit concerned about this recessionary talk, is when it starts to get tied into what's going on with this trade war. And certainly we have some reason to believe that the media is sensationalizing what's going on in the economy and turning every data point on the economy into something much more serious about the state of the economy than maybe it needs to be interpreted. And what does that mean? What do we think is behind this sensationalization of every piece of weak economic data by the media, Kyle?
Yeah, I mean, it seems like this could be politically motivated. We're basically trying to create a recession by undermining consumer confidence in our economy by talking about this to no end, that there's a recession coming in and be afraid. The net of that would be that Trump is kind of ousted from office because he's not going to get reelected amidst a recession. That's highly unlikely. So anyway, the political motivation seems kind of quite clear.
Yeah, we certainly can wonder if this recessionary talk by the media, who has proven to be quite anti-Trump for the last few years, is centered a lot on trying to push us into a recession, to try to drive Trump out of office, and hence tying it to him as well by labeling it all about the tariffs and the trade war that took this economy into recession.
Right.
We certainly have reason to believe that this is some sort of propaganda that's being distributed by the far left media right now against the president, and in an effort to bring this economy to its knees.
Yeah, I think that's a fair way to characterize it. There are, in all fairness, some economic data points that have looked worse, possibly as a result of the trade war. But the reality is that a lot of the arguably more important data points, specifically those tied to the consumer, still look quite positive.
So let's talk about the state of the economy. Let's no sensationalizing. Let's get to the brass tacks here about where the U.S. economy is, and do we have any of the classic signs first of a recession on the horizon. Classically, when we get a recession, what do we typically see? Generally, it's a result of Federal Reserve posture that became too harsh and shocked the economy. Has Federal Reserve posture been a shock to the economy?
Right, so that hasn't happened. And usually what, they're being too aggressive as a result of there being some asset or something that ends up getting kind of highly inflated, and they have to chase that and try to clamp down on it by being aggressive with their policy. It might be the price of oil spiking too high. And classically, the
strength of real estate that we had in the last cycle.
There you go. There's something that's kind of this obvious asset that looks primed to bust, and the Fed is chasing after inflation that's gotten away from it. They're being too aggressive in the face of that asset starting to tumble in value, and this classically leads us into recession. We're not seeing that.
We were very concerned about a recession here at Mitchell Anthony Capital Management back in the fourth quarter of last year, after the Fed had raised rates 100 basis points. The Fed did raise rates 100 basis points in 2018, and it did shock the economy a bit, but 100 basis points is not a lot when they were virtually at zero. And we had a bit of a slowdown in the economy result in the first quarter of 2019. But it really, we've been watching it here at Macam, and we haven't seen this really developed. In fact, as you're saying, isn't the consumer part of this economy still quite good? What are the evidence you can point to of what's happening with the consumer side of our economy, which is, 69-70% of GDP?
Right. This is so the biggest and most important component of GDP, this consumer, right? They're still seeing fantastic, the best that they've been since the last recession, gains in their wages, unemployment, all-time, historic lows. The consumer is out there spending at some of the highest levels of all time. Their confidence, all-time highs. For all this doom and gloom, the consumer doesn't seem to be part of that equation.
Right, and it seems that it's the strength of the consumer has not been really shocked by this tariff talk, believe it or not. It's shocked investors, and investors have sold off, real estate, sold off equities, sold off, investment assets, and ran into treasuries and gold off and on over the last year, as we've had this worry about tariffs, and we did have some Fed action, but for the most part, the consumer has been resilient and hasn't really went into hiding as a result of all this tariff talk. So it seems like the consumer is not believing the media, at least hasn't thus far. Is that fair to say?
That's fair to say. We have not seen evidence that this has really caused great concern for the consumer. In terms of their spending, we're not seeing layoffs en masse from businesses as a result of thinking that maybe demand's not going to be there for them. It's just not playing out like that.
Where are we seeing some weakness? So we are seeing some, the media is not totally out in left field here. They are kind of taking some weak data points and sensationalizing it. The Wall Street Journal had a big tiff with Peter Navarro from the White House over the weekend. This kind of unsigned columnist at the Wall Street Journal came out and really poo-pooed on the economy and said the U.S. economy is in terrible shape and feeling a huge burden from tariffs. There was this big editorial piece in the Journal that nobody wanted to attach their name to. And finally, one of the editors at the Wall Street Journal attached his name to it and took on Peter Navarro, who exchanged some barbs about it. But there has been some weakness on the corporate side of our economy in terms of spending from corporate America, correct?
Yeah, that's exactly right. There's just, with the uncertainty, particularly because there's been so much concern raised about what might happen with respect to the trade war, it seems like some businesses are maybe trying to play it a little bit safe in the midst of uncertainty. And so there's been a little bit less business confidence. Some kind of manufacturing, purchasing data has been a little bit soft, which seems not totally unreasonable in the face of some uncertainty.
So let's talk about who's editor of the Wall Street Journal who finally, put his name on the piece?
Right. So this was James Freeman.
James Freeman.
But that is a fair point. It shouldn't go without mention that this kind of article, blasting Peter Navarro and calling for the recession in the Wall Street Journal was basically unsigned. There was no editor that was willing enough to kind of, or writer to kind of step forward and say, look, this is my opinion. This is how it's going to play out. They just kind of hid behind the editorial board.
But the article kind of talked about the heavy, heavy burden that the U.S. economy has upon it from these tariffs. Is that a fair statement to make?
We haven't seen the evidence that these tariffs are really impacting the businesses or the consumers really much at all.
How big is our economy?
Right. This is a $17 trillion economy.
It's a $17 trillion economy in terms of total GDP. And the tariffs thus far are in the 300...
Yeah, we're talking in the billions, 300
billion range of products that are tariffed, not actually what the cost of the tariff is, just how many billions of trade goods are being tariffed. Yeah. When you start to think about a 25% tariff on 300 billion of goods, you're getting down to $75 billion in a $17 trillion economy. How does this guy Freeman say this is a heavy, heavy burden upon the economy unless he's sensationalizing data and trying to twist data?
Even if this was a 100% tariff, right, still that full amount is just not enough to be this huge impacting factor. So you're totally right. I mean, it's hard to call that anything other than sensationalization.
I mean, we do have some other weak things to talk about, honestly. That we know the consumer is strong. We know the industrial manufacturer side of the economy has softened a bit. It's not in recession by any means, but it has softened a bit. We look at our export picture. There's really nothing wrong with exports. You can't say our export picture is in recession. And we look at government spending and we see modest to moderate strength there too. In fact, government spending is probably about as strong as it's been for the last 5 years. Isn't that right?
Yeah.
So, our engines of consumption that drive the U.S. economy, for the most part, are good. We can point to some other things, though, that have people concerned. And we'll get to those, being the yield curve. But let's first talk for a moment about not the media, who really aren't economists, but are politicians now. Let's talk about our people of wisdom in the world who kind of look at our economy and try to tell us what's going on. Our Jay Powell at the central bank, at the Federal Reserve, Janet Yellen, past Federal Reserve governor. The American superstars of corporate finance, Merrill Lynch, Morgan Stanley, Goldman Sachs. What are the economists of these great firms saying? Is any of these people preaching recession and saying the probability of recession is an odds-on favorite?
Right, kind of across the board from people to whom we should look to for a good opinion on this. They're all not saying that recession is here. Yeah, but the Federal Reserve, members past and present, these American superstars, as you call them, it's just there are not strong calls for recession by any means.
Janet Yellen out making comments last week said, I don't think we're going to see a recession. We had a little bit of shock on the economy from the 100 bips of central bank policy last year. I do not think it'll bring about a recession. Past Chairman Greenspan, likewise echoing those same sorts of comments and actually explaining what's going on in the yield curve as arbitrage, and that most of this most of these purchases that are driving interest rates negative and inverting our yield curve are a result of traders who are buying U.S. treasuries and shorting German treasuries because they're negative right now. They have negative yields. And it's really, and also it's a little bit about institutional allocation of capital back toward fixed income because of heavy exposure to equities they got.
Right, yeah, this is, you look at the problems that Europe is kind of still having. They never really reaccelerated after the recession. And these countries in Europe are just kind of plagued by these structural unfortunate circumstances and burdens that they just refuse to rectify. And so as a result, they're having to take these stimulative measures like taking, having negative yielding debt. And so, in that instance, of course, the U.S. debt looks highly favorable. So everybody's sending their money here to buy a couple of percent yield. And so it has an impact on the curve, where historically the curve has inverted because, the Fed perhaps is behind the game. Investors can already kind of see a recession coming, and the Fed is too slow to act, so that short end stays too elevated for too long. And that's not what's happening right now.
Right. I think that's fair. Well said, Kyle. I think the yield curve is inverted as a result of investors finding value in our long-term bonds in a world of negative yields, not because the Fed ramped up short rates above long rates. And so I think that kind of gives us some explanation of what's going on in the yield curve. And I guess in the end, we're coming to this conclusion that there's just this fear of a storm that we've been kind of going through for a while, turning into a hurricane, seem a bit unfounded, right?
Yeah, we have ebbed and flowed for the past, decade since the recession. And it certainly seems like we might be going through a bit of a period of ebbing on some economic data points. But yeah, this is not recession time. We're not collapsing.
I think we're not in a great economy. We don't have any great engines of growth. It is interesting now after 7-8 years of economic expansion at pretty slow rates, we have full employment and a pretty strong consumer, but we still don't have any underwriting great consumption themes that are driving our economy. But that's also another reason why it's not going to bust.
Right.
Busts generally come from exuberance that developed as a result of a consumption theme that went awry.
That's part of what is so interesting, exactly, is that we haven't had this, like housing prices didn't go crazy through the roof and now it's ready to bust, or tech stocks didn't go through the roof and now it's time to bust, and there was this irrational exuberance. That has not been a characteristic of this cycle, so we don't seem vulnerable in that same way.
The characteristic of this cycle is more of an economy that's ebbing and flowing. That's the characteristic, kind of broad, steady consumption themes that push us forward. After pent-up demand gets met, we ebb back a bit, and then pent-up demand starts to develop again, and then we grow forward again. And I think this is the cycle that we're in. It's a cycle of highly valued assets, whether it's real estate, whether it's stocks, or whether it's fixed income. I think they're all going to stay highly valued. The best returns in the year ahead still look to me to come from stocks because they're the best valued relative to all asset classes when you look at historically how these different asset classes have been valued. So for that reason, we're continuing to kind of stay optimistic on what's going on in the U.S. economy. We'll continue to watch and hope that the media, in a reckless manner, does not bring this economy down into its knees, but we certainly have those concerns, and we have to watch for those signposts of trouble and act appropriately if that in fact happens.
That's fair.
So I think that wraps up another episode of Beat the Bogey. Thank you so much for tuning in today, and we'll be back because there'll be more news flow next week to talk about again.